the foreign central bank, you've lost control over it. Are you going to get it back?
Mm-hmm.
You don't know. What you are likely to do, however, is to take the view that you're going to exit this leasing game. There's no point, because if you can't secure your asset, why lease it? And I don't know that that silver was leased from China and delivered into the London market. I mean, I would doubt it personally, because apart from anything else, the People's Bank of China actually controls the silver market as well as the gold market. You can't move without getting permissions from the People's Bank of China. But the amount of silver in the Shanghai Futures Exchange vaults, as far as I can see, has actually been falling. So I think that's been taken out of the vault.
The cracks in the global bullion system are widening. The era of endless gold leasing and rehypothecation, where multiple parties could claim the same bar of gold, is quietly coming to an end. Central banks are realizing the danger of losing control over their own reserves as liquidity tightens in London and COMEX faces growing strain. Meanwhile, physical metal continues to flow eastward. China and India are steadily withdrawing bullion from Western vaults, building a system centered on tangible assets rather than paper promises. The Shanghai Gold Exchange is expanding its global presence, signaling the emergence of a new gold-based trade settlement system that could gradually replace the Bretton Woods system over time. Alastair Macleod, a respected economist and head of research at Gold Money, explains that this shift marks not just a monetary adjustment, but the collapse of the entire fiat experiment. As Western currencies lose credibility, commodities, from gold and silver to base metals and food, will reprice sharply higher. The lesson is clear: own what you can hold. Now, we present the clips from Alasdair Macleod's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Earlier this year, we found, much to our amazement, that bullion was being taken out of the Bank of England's vaults and shipped over to COMEX to benefit from the arbitrage, as it were. The arbitrage was the other way. London was below COMEX. COMEX, huge, great premium. Why? Because of uncertainty of whether gold will be tariffed or whatever. So, but the thing about it is that certainly commercial entities do not store very much gold in the Bank of England. It is mostly, and when I say mostly, not quite entirely, but because we don't really have the true figures, it is other central banks. What will have gone out is leased gold. Now, put yourself in the shoes of a central bank using the facilities of the Bank of England, which until now you felt quite confident because you know you lease your gold. Basically, it pays for the storage costs, and also you get a bit of a margin on top, which means that you've got this sterile asset which is actually earning you something, which is great. You have the comfort that the Bank of England is going to continue to store that gold over the life of the lease. All that's happening is that there is a book entry transfer system. The bullion's got to remain in a vault, for goodness sake. So it may as well remain in the Bank of England's vault. So as a foreign central bank, you're sitting there quite comfortably. You know, at the end of the lease period, you haven't lost control over the gold. Now, this is very different from the early days when gold was actually taken out of storage and then sold into the market as part of the carry trade, whereby hedge funds and others would go and buy T-bills. I mean, T-bills in those days were yielding as high as 10%, and over the decades fell to something like 5%. And with gold you could lease at 1%. I mean, it was a trade in heaven. It really was. But now, the Bank of England doesn't behave like that. The Bank of England controls it. But the key thing is that if you lease gold, it is actually your property over the duration of the lease, so you can do what you want with it. So the Bank of England couldn't stop it going out. But looking at it from the point of view of the foreign central bank, you've lost control over it. Are you going to get it back?
Mm-hmm.
You don't know. What you are likely to do, however, is to take the view that you're going to exit this leasing game. There's no point, because if you can't secure your asset, why lease it? So on that basis, I think what the London market is finding, and you won't find anyone writing about this, right? What the London market, I think, is finding is that there is a tightness of supply. I'm sure the bullion banks are completely aware of this, because if what I'm saying is true, and I believe it is true because it's a reasonable assumption, then the bullion banking, the LBMA community will know that they have got to manage things, if you like, with less liquidity, physical liquidity in the future. So this idea of hypothecating, rehypothecating, that story is coming to an end. And it's interesting that at the LBMA's annual bun fight, which was last week, they did a poll of attendees. They always do this to see what they reckon the gold price is going to be at the end of the next year or by the time of the next annual meeting. And the average came out at just under $5,000. So, these guys know that it's going up and they're going to keep, they are doing a pretty good job of keeping on an even keel. I think that the bullion banks in London do have a bit of stock. Now, I don't know that they've covered all their liabilities because they also have unallocated accounts, and those unallocated accounts are just generally covered and not necessarily totally covered by gold. So, but they have got that little bit of liquidity and they're not losing it. The problem, if anything, is likely to be on COMEX. China and India were supplying silver on the really big backwardation, when we saw backwardation of $2 or $3, whatever. And I don't know that that silver was leased from China and delivered into the London market. I would doubt it personally, because apart from anything else, the People's Bank of China actually controls the silver market as well as the gold market. You can't move without getting permissions from the People's Bank of China. But the amount of silver in the Shanghai Futures Exchange vaults, as far as I can see, has actually been falling. So I think that's been taken out of the vaults. But you see, I would expect this anyway, because industrial corporations, making solar panels and all the rest of it, they keep their stock in these vaults. So they'll be drawing it down anyway. But I think the liquidity is diminishing as a result. So, the whole thing is tightening up, but not necessarily in the way in which you were suggesting. If you look at a central bank that's been accumulating gold and selling dollars, in most cases, they've probably still got more foreign currencies, more fiat currencies than they have gold. I think what they're doing is they're trying to protect themselves. This isn't a trade, if you like. Right. If you see what I mean. A trade giving them a benefit. So, the whole system it's basically the whole of the fiat currency system is coming to an end, which threatens the very existence of central banks themselves. So I don't see that, they're necessarily happy about this. There is the geopolitical side of this, of course. China has more or less cornered the physical market. And we now know what China's plans are to protect the yuan. Basically, the SGE is opening vaults in Hong Kong, and also they've already opened in Hong Kong, I understand. They're also opening in Saudi Arabia, and there will be facilities all around the ASEAN nations whereby you can settle trade differences in yuan or gold. And I see today Cambodia has announced, I don't know that this has been verified, has announced that it's prepared to store its gold in Shanghai Gold Exchange vaults. So we can see that as our system here collapses post Bretton Woods, post Bretton Woods is coming to an end. Chinese understand this. This is why they've cornered the gold market. They have protected themselves from our follies, from our destruction, from our debt problems, from the collapse of our currencies. And consequently, they will put their currency on some sort of gold standard. And we can see how this is going to be rather like a sort of Bretton Woods too, but only in trade settlements. I think that's the way it's going to work. But this is something which is as much driven by necessity as geopolitics, if you like. So to answer your question, I can't see there's a clear case of central banks seeking to profit from this. I suppose that there are some smaller nations, maybe within the Shanghai Cooperation Organization, who are very gold rich in terms of resources. They're probably, some of the officials there may be cheering from the sidelines, but nothing really material as far as we're concerned. Well, obviously, if you're looking at fiat currencies going down, and the other way of expressing this is the way in which everybody's expressing it. You're going to see gold and silver rise. It's also true of base metals. Base metals priced in gold are the cheapest they've ever been. They really are. Now, this is because gold front runs things, admittedly, but it does tell us that next year we're going to see base metals and other commodities, foodstuffs, for example, rise in price very substantially. And I know nobody's expecting this, but this is what's going to happen. So, that I think gives you some clues to how you should structure a portfolio. But as far as I'm concerned, there is another problem there, and that is you don't own anything. When you might sort of have an electronic record that you hold shares in, say, Newmont Mines or something. You don't own it. Basically, what happens is that the management of Newmont Mines has an obligation to deliver to its shareholder an income stream, if you like, in the form of dividends and accumulation within the balance sheet. But who's the shareholder? DTCC or Euroclear. They're the shareholder, and they've got a knock-on obligation to you. So when the whole system falls apart and markets need to have collateral in order to continue to survive, guess what? They'll take what you think are your shares, because they're not your shares. They'll all be pledged. So this is why I say just get the hell out of credit. You don't want to have credit at all.
The global financial system is reaching the edge of credibility. The once reliable trust in Western monetary management is fading fast as central banks quietly lose control over their own gold reserves and confidence in fiat stability collapses. Years of over-leverage, leasing, and opaque accounting have left the system fragile, hollowed out by promises that can no longer be fulfilled. The Federal Reserve's attempts to inject liquidity are merely buying time, not solving the core issue. Every new round of quantitative easing deepens the dependency and accelerates the loss of faith in paper assets. The real risk now lies in credit itself. When confidence in government and banking systems erodes, credit instruments, including bonds, ETFs, and even equities, become liabilities rather than stores of wealth. Those who understand this shift are moving away from promises and toward tangible, final settlement money. Gold and silver aren't rising. Currencies are falling. The end of the fiat era is approaching faster than most realize. Let's get back to the interview.
I think there's a big shortfall. So you've got a credibility problem, which is being well aired, and it's well aired even by people like Scott Bessent. Guess what? As soon as he becomes Treasury Secretary and he gets his feet under the desk in the Treasury Department, what happens? He is told, don't say anything about gold. Stumm, don't talk about it. Why? Well, I can see two reasons why. Firstly, they are in denial about gold because they have been promoting the dollar as gold's substitute, if you like. It's a dollar standard around the world. The second thing is a lot of that gold, I think, went out. It was leased and never came back. You open Fort Knox, I think someone rather cleverly said, you find a whole bunch of IOUs sitting there. We don't know whether this is really true because, of course, we can only surmise. But intellectually and practically, I think it's going to be extremely difficult for the mighty dollar to if you like, get away from its total collapse. So that's what we face. I mean, this is a very serious time. We are in a sort of, if you like, in an intermediate stage where, the Fed is trying to put some liquidity back into the system because it sees the danger. It's been told the danger by its intelligence in the commercial banking network. That will give us a little bit of relief. It might even puff equities even higher. I don't know. But the only way you can get out of this, basically, is get the hell out of credit. It's really dangerous now. Get out of credit, which means getting into real money, which is metallic money with no counterparty, and it is final settlement for all credit, and that is gold. Yeah, well, it's impossible to say how long the final collapse of the dollar will happen. And you never know. I may be wrong. You could find that the authorities turn around and actually do something sensible like secure the value of the dollar somehow. I mean, there may be some sort of fiddle they can do and all the rest of it. I mean, people have been talking about a reset for ages. It's not a reset. It's just to try and secure the value of the dollar. The only way that can be done ultimately is basically by going on to a gold standard. This slide, I think, could happen quite quickly. I mean, once the credit bubble bursts, I've got people who sort of, seem to have been very successful in terms of, reading cycles and things like that. And I think we're looking at March next year, ultimately. But I wouldn't be surprised if it happens before that. When that happens, then basically, I know this sounds, a bit panicky. when that happens, basically, you should already be completely out of credit, because the collapse, I think, will be really quite rapid from that point. And they will obviously try and do what they can to stop it and all the rest of it, but it's just going to undermine the purchasing power of the dollar. So in terms of time, I don't think we're far away from the end of the fiat currency system. And the point about being close to the end of the fiat currency system is that we're close to it. Fiat currency is not being there. Now, either they're replaced by something else like a new gold-backed currency or whatever, or they tie it to gold. And incidentally, have to take the economic actions to ensure that it sticks. We're nowhere near that. Nowhere near that. I don't know. I just sort of feel that we are actually moving more rapidly than we think towards the end game of fiat currencies. Mm-hmm. It could be a year, could be 2 years, could be 3 years. I don't know. Just watch. I think the first indication you will get is when the credit bubble pops. You'll then know that the end of the fiat currency system is not going to be terribly far behind. I saw one estimate that the Fed's got to put about 150 billion into financial markets, which will do by QE. It's got to do that pretty quickly. If it does it pretty quickly, then you're not going to see too many of these problems in the short term. And hey ho, the markets will continue to rise. Wonderful. But, this is a very, very febrile time, Danny. It's very dangerous. Do you want to sort of ride this roller coaster until it sort of runs into the buffers at the end, or would you rather not play? I mean, that's the decision. That is a very difficult decision I think investors have. To my mind, it's actually quite simple. Just get the hell out of credit. If someone makes an equity the last 10, 15% in equities, then good luck to them. You never get out at the top. You never, ever get out of the top. I saw one estimate that the Fed's got to put about 150 billion into financial markets, which will do by QE. It's got to do that pretty quickly. If it does it pretty quickly, then you're not going to see too many of these problems in the short term. And hey ho, the markets will continue to rise. Wonderful. But, this is a very, very febrile time, Danny. It's very dangerous. Do you want to sort of ride this roller coaster until it sort of runs into the buffers at the end, or would you rather not play? I mean, that's the decision. That is a very difficult decision I think investors have. To my mind, it's actually quite simple. Just get the hell out of credit. If someone makes an equity, the last 10, 15% in equities, then good luck to them. You never get out at the top. You never, ever get out of the top. Well, I mean, obviously it had run extremely well, and you could argue that there were profits to be taken and all the rest of it. The thing that's fascinating, though, is that while traders would have done that perhaps in futures and perhaps also in Shanghai, you still had a backwardation between London and COMEX. Mm-hmm. And if you look at the volumes in the silver contract on COMEX, I mean, it's just gone to a crawl. They're not dealing, basically. So nothing has been resolved. You've still got the problems there. There is no liquidity in London. If the shakeout has discouraged ordinary people from going in and buying ETFs, which is a real problem because, the ETFs basically, if you look at what's stored in the London vaults, it's almost all ETFs. So if you get subscribers going in for silver ETFs, then, the problem is going to come back in spades. So, it's still there. And I don't think what we have seen has really discouraged the retail market, if you like. I mean, everybody I talk to around the world, they're still incredibly busy dealing in coins, small bars, and all the rest of it. The public are still buying this. I think there's a bit more two-way trade, yeah. But, the Perth Mint has got nothing. It's sold out. And this is a story I'm hearing all over the place. So there is tightness in these markets. Now, I think the hope is that you can just sort of sit on it for a little bit. Then, the enthusiasm will go away. This has happened before when we saw the spike in silver. Was it back in, can't remember when it was. It was not all that long ago, a few years back. The enthusiasm went away because they just basically ran up the price and then bashed it, which is roughly what, that's the standard tactic, basically. How long this consolidation is going to last is difficult to say. The clock is ticking on the shorts. That is really the problem. And if you're a trader, then good luck to you. You got your life in your own hands. That's not what we're talking about. If, on the other hand, you're a stacker, then you say, hallelujah, I can buy some stuff a little bit cheaper than I thought I could yesterday. And that's the right attitude to take. Just keep stacking. I mean, we've seen it before. You sort of see price run up and then it comes down and all the rest of it. And everybody says, oh, it was overbought and stuff. So they stop buying and then it runs away. And suddenly they find that what they sold, say at $2,700 or $2,070, which is where it consolidated after COVID, they're out of the market. And here we are close to 4,000. Help, what do I do? I mean, idiots. You've stacked for a reason. You're getting out of credit. That's the whole thing. It's not gold going up. It's the dollar and all the other fiat currencies going down. And we can now see the path to their complete destruction. That is the key thing. This is not a time to accumulate wealth. It's a time basically to secure what you've got. And that means getting the hell out of credit.
The system is entering its most fragile stage yet. Liquidity injections and rate cuts can no longer hide the deeper issue. The foundation of credit itself is cracking. Every central bank intervention, every new policy pivot only delays what can no longer be postponed: the repricing of tangible assets against collapsing currencies. The signs are already here: tightening bullion markets, silent central bank accumulation, and retail investors quietly draining physical supply. These are not coincidences. They're symptoms of a system losing confidence in its own paper promises. We're not witnessing an ordinary cycle. This is a monetary transition. Those who understand that real wealth isn't measured in fiat, but in purchasing power, will emerge on the other side positioned, not panicked. The key now is to preserve, not chase. Protect what's real, hold what endures, and stay ahead of what's coming next. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.